Wealth Elevator Podcast. I got a guest today, Buck Joffrey. Buck and I go way back in 2016 at one of these real estate conferences out there. He bought me lunch, and after that, I was best friends with him because if you buy me lunch, I'm a sucker for that. Buck used to be a doctor, and he changed his life just like how I did after we found real estate. But Buck, why don't you give me a little bit of background on investing wise, early residency, and then we'll go from there.
Yeah, so I finished training back in I think it was 2000, 2009, something like that. And then pretty quickly I got inspired by the Kiyosaki stuff and started treating my medical stuff very much as a business. And so I was a cosmetic surgeon, so I made it a little bit easier. So I just started ramping it up with a bunch of marketing. I didn't put my name on the door. I branded it with a different name rather than trying to make myself another famous cosmetic surgeon because there was only one of me. That ended up doing pretty well. And within a year or two, I was making seven figures, probably after 1 year, actually. It was pretty quick. And my dad, I grew up, continues to be a real estate investor at 85 years old. And to me, I didn't really know what else to do with my money. So I started buying real estate. And I actually didn't really learn much from him because I never paid attention to him. I never thought he was like, knew what he was doing or whatever. It wasn't, but Robert Kiyosaki was happy to listen to. But funny thing in hindsight is my dad is pretty much Robert Kiyosaki, and he's the Indian Robert. He's got the same temperament too as Robert, it's really strange, but a little bit volatile and that sort of thing. Anyway, so I started buying stuff. I went through some transitions with other businesses, but what I should realize is I made a lot of money in those initial buildings. They bought small apartment buildings, and a lot of it was just luck. But I was in the right place at the right time, and getting 500% returns in 2 years wasn't normal, but that's what happened 2 or 3 years. And so I got the bug, and I wanted to go bigger. And when I was already podcasting and talking about what I was doing. And before you know it, decided to try to take things to the next step and do real estate syndication. And here we are, right? It's been a ride, and real estate has been really good to me. And in the last year or two, it has not been particularly good to me, but we've talked a little bit about this. Part of it is how long have you been in the game? How much money have you made? And then can you absorb the losses? And that's where I'm at right now.
But before we dive into lessons learned and current, let's talk a little bit about that first year. What year was that the year you plowed some money into some apartment buildings when you were still in those wealth
It was
generating
probably
years?
it was probably like 2011, 2012, maybe.
I mean,
Yeah,
you
you
got
might
that
have.
you had that doctor and entrepreneur salary. So that's the key, right? You plowed a whole boatload of money from that
Yeah.
venture into passive investing. The first year or two, what was your profit out of the business, and what percent of that did you plow into real estate, would you say? Because I think this is what gets lost, right? We have a lot of people out
Yeah.
there that are entrepreneurs or maybe make great tech salaries, 500 grand, and they save 200, $300,000 a year.
Yeah.
What were
So,
you, what percent were you plowing into this passive investing thing back then?
early on, I didn't have much. I didn't even own a house quite yet. 2011, I was renting, and I had one daughter she's in high school now, but she was a baby. And I
Even
was
more so, you had responsibilities, right? It wasn't just
It a responsibility, but I had like plenty of time to fix it if I screwed up, so I wasn't too worried, right? And yeah, out of that $1 million a year kind of thing, I would say probably three quarters of it was going into, at least was going directly into investment. 75%, 80% of what I was making was going into investing and building.
Yeah, likewise here. You and I were doing the same thing. Two squirrels running around hiding our
Yeah,
nuts from
yeah,
2012 to 16 was just plowing
yeah,
away, right?
plowing away. Yeah. Yeah, yeah, lots of money going into real estate, and that's really where it's at, right? Is getting it in there and getting it deployed early, and the next thing you know, 10 years comes by and you've added a zero to your net worth.
Yeah, that's the iceberg analogy. What we're gonna be talking about is the ice on top of the water. It's like you got a dollar cost average, myself 2009 to 2000 and whenever, and then Buck starting in 2000 with his phenomenal income there. It takes a long time. There's not the get rich quick scheme. But then once in a while, like they say, market corrections every what 7, 9 years, and this one was a doozy, right?
Yeah.
I think you've been a good help to me. It's emotionally not the easiest of things, but when you have other people like yourself, I think you and I connected several times over the last couple of years on this. Definitely very helpful to myself. Hopefully I was able to do the same or but
Yeah.
how did you maybe just talk about emotionally dealing with it?
Yeah, I think it's a tough one, right? Because my biggest thing is like how this whole thing has affected our investors. And the thing is that those people who were with me early on, they're still doing fine, right? Because we made a lot of money really quickly and we were on 30s and 40s in terms of IRRs and that kind of thing. And then the next thing, so if you piled on a few of those, then if you ended up losing some money, you still net are ahead, or maybe at worst you're breaking even. But who I feel bad for, and I think from an emotional standpoint, is people who got involved late. And I feel bad for them because it's a bad experience. It sucks to be in that situation. But also, I think it's a bad perspective to have about this space because I think if you zoom out and you see the opportunities to make a lot of money, you may still stay in the game. But if your only experience was getting like beat up in one deal or beat up in a couple of deals that you put your finger into and somebody came at it with a hammer, beat it down, you're probably not going to go back in, right? So I think that's what sucks about it. I think that it sucks at people when people lose money. It's a lot more fun when people are making money. But again, I think emotionally, I think as an investor, you have to be tough. You have to think about what Warren Buffett always said, right? Like you be greedy when others are fearful and be fearful when others are greedy. And I think when you look at right now, everybody's fearful. I don't blame them. There's not a whole lot to be necessarily greedy about because I think there isn't a huge amount of opportunities. I thought there would be more opportunities by now, but there isn't. But when there is, I think a lot of people are going to be scared and they're going to miss out. And then the next cycle, when people are making a bunch of money because they got in when things sucked and they make a bunch of money, and that's when other people jump in, and then the next thing you know, they get screwed because they got in too late. That's the way this thing works. But I think if you zoom out on it and you think about it rationally, that's where you end up with a level of sophistication because investing is not normal. It's not for a normal human being to do well because it's against the emotional wiring that we're made up of.
Yeah, like how I don't play poker, but the good poker players will tell you this is not a game of cards, it's a game of reading emotions and judgment on
Right,
that. Similarly,
right.
investing is when things are queasy and uncomfortable, and then you throw on top of that the recency bias of getting hit with the hammer in 2021, 22. That's when you should ideally invest the most, right? That's when the time is getting good. That's when from a
Yeah,
high level perspective, that's when cap rates are at 6 or 7, and you shouldn't be buying things when things are at a 4 cap rate.
yeah,
Simple as
right.
that.
It's just that's where I feel like we haven't even gotten there yet because the tricky thing is in this multifamily market we're in right now, there is this discord between buyers and sellers. And a lot of that has to do with the fact that interest rates were going up and then they seemed, or inflation rather, it was going up and then it started to come down and it seemed to start to stabilize. And once you have inflation settled, then cap rates can find a new home, right? They can stay stable somewhere. And that's when you can actually underwrite something. You can underwrite something as a buyer, you can underwrite as something you can determine as a seller what your point of selling should be. But when you have something that is a moving variable that's so critical to the underwriting process, you're not going to have a lot of activity. And that's exactly what we've seen in the multifamily space. We've seen very little movement of assets. So once that settles down, I think there will be, at least for a period of time, a buying opportunity because, as we all know, there's a lot of interest in multifamily space and there's going to be froth again. There is going to be froth again. I guarantee it. It's as much as I can guarantee that Bitcoin will go back up over 70,000 over a period of time. And the same kind of thing.
Yeah,
So,
the times are to be in it are right after the bounce off the bottom, right? Which you
right.
would, in theory, call it now. Let's just look back in history. 2009 to 2012 was that bounce. You and I were in real estate at that time. That was the best time. And ideally, one would pinpoint that as current day today. And then very at the end, right? 2020, that's the second froth. everything, there might be some undulations in the middle, like how we had in 2016. That was a golden age of apartment investing. But it's on these edges right after and right before. And for people who say, I'm just going to wait, the only other frothy point you're going to hit is right at the end. And it's going to be too late to get out at that point.
Yeah. The thing is that with this cycle, I wanted to exit everything in 2021. And for some reasons, there was decision power in some of these things was not mine. But I think one of the things you got to be able to do is put aside some greed when there's froth and say, okay, it's possible I could make a lot more money if I stay in for the next couple of years. But right now I'm way ahead and I'm going to be happy if I sell. Others, my investors will be happy if I'm going to sell. And that's what you do. Make no mistake, I think that this what happened in the last couple of years, it was hugely unexpected, right? The Fed you did not even really think that this was going to happen. They called it transitory when it was happening with inflation. So to have
40
this
year
kind of
40-year highs in interest rates, but the quickest time in history,
yes,
statistically.
from a slope, right? As you engineers would like to call it,
The
the
derivative.
acceleration. Yeah. So that derivative was the greatest in history. And that is something that when you hit those situations, it is really impossible for that not to affect markets. I don't care how good you are. I mean, it's just going to affect a lot of stuff. So that's what we saw. And now the question is what happens next? And that's where I'm waiting.
Yeah, but before we move off to kind of what happens next, what is through it? And we've had some time to heal objectively, like any lessons learned that next, when will this be? You'll be like 2020, 2031, right? Like when that comes
The,
around, what are the signs or what can you take away?
I think what I was saying before is once you get into this period and you start looking around, I use the analogy of cryptocurrency and Bitcoin a lot of times, right? When your barber starts talking about what altcoins to buy, it's probably time to get out, right? It's really difficult to understand or to recognize when you're in a bubble. Otherwise, there would be no bubble because people would recognize it all the time, right? You have to set some benchmarks ahead of time and say, if this and this happens, then I'm going to sell, right? I am going to periodically look around and see what's happening in this market and determine whether I think that it's frothy. If it is frothy, I don't want the exposure. I'll be out. I will take a break. And if this continues for the next 2 or 3 years, then people will say I got out too early, didn't make money. But at the end of the day, if you go back in 2008, 2009, no one is pointing at those people who exited in 2005 and 2006 making a lot of money and laughing at them. Nobody is, right? They got out and before the shit hit the fan, whether that was 2 or 3 years before they could have been making profit or not. So I think the big thing is to understand when you're ahead and take chips off the table. You got to keep taking chips off the table. You can't just keep it all there.
It definitely applies in like the crypto kind of thing mindset, right? I think I don't do crypto like how you do, but I
Yeah.
really it magnifies things and it makes you very more theoretical type of an investor, right? It makes you think about things in this way and it helps carry over to your slow moving, archaic real estate investing.
The cycles in cryptocurrency, they're the same cycles, like the ups and downs, but they happen so quickly. Like we're already like 1,000 years, like you think like dog years versus regular year to the regular markets. Things happen so fast. Look like even Bitcoin going up all-time highs and dropping 20%. Now it's like sitting at 50 grand. And if you look at the greed and fear index, it was like at an all-time high like a week ago and now it's low. It's just and right now, if you believe in Bitcoin, it's exactly when you should be buying Bitcoin. Not when it's at all-time highs, but when it corrects to 25% like it did just now. But I guarantee you, when Bitcoin goes over 100,000, you're going to have a bunch of people buying Bitcoin. They're going to buy other altcoins. It's the same thing. It's just like humans are not meant to do this stuff. It's just we get sucked into the emotion. And good investing is literally doing the opposite of what your emotions tell you to do.
And I think that's the other weakness for investors who aren't connected, who aren't ingrained in communities. The best thing you have is what's spoken on podcasts, which are essentially just marketing tools out there. And especially in some of these like doom and gloom forms that just scare the crap out of you. And make you want to click their affiliate link to buy gold from them.
Yeah.
But what advice do you have for that busy professional who doesn't have that community, right? Like, where do you go
Hmm.
to hear that when things are getting frothy and you don't have those compadres around you? What other sources are there to help you identify what you just said?
I think one of the things that we've done, and you do, you have your own communities. Like you, people who listen to you, there are probably a certain like mind when they find each other and they build their communities. It's not just me. I certainly have my opinions, especially in the podcast ecosystem. Real estate is tricky because, as you mentioned, there's so much doom and gloom with the gold bugs and all that, and the zombie apocalypse people and all that. But you have to try to formulate your own thoughts and make some decisions. You have to be able to take information from multiple sources and try to formulate your own thoughts. But it's also helpful to have a community. And if you find your fellow engineers, and I know you guys have some meetups, things like that, it's always helpful to build those small micro communities as well.
Yeah, I actually discovered talking with other investors, the engineers, there's a lot of them, but they're actually the worst investors because to be in this investing thing, you need to not be super rational because it'll screw with you, right? So just throwing that out there for the engineers, you need to not act like an engineer in a
They don't
way.
talk to each other. So doctors are the worst, but they are very challenging because they all think they already know everything.
Yeah, you don't have that too much with engineers because our salaries suck. But yeah,
Yeah,
that alpha I know everything mentality is
yeah.
definitely not good for investing where you need to take
Uh-uh.
in data points at all times. But before we start to beat down any other occupation out there, let's switch gears to head off into the future. What's your thoughts on real estate today, and are you looking elsewhere? Right? Has the honeybee nest been beat up and we're all scrambling for new homes out there?
No, I think that for me, listen, you dance with the girl you came to dance with, or whatever the old saying is, right? At the end of the day, I wouldn't be where I am if it wasn't for real estate. And so I'm not giving up on it. I do think that there are cycles. Obviously, I am probably 80, 85% real estate. And times like these, I wish I wasn't 80, 85% real estate because I've lost millions of dollars. But on the other hand, I had the millions of dollars to lose. And that was from real estate as well. So I think the thing to think about is maybe your portfolio should be more balanced. Maybe my portfolio should be more balanced. Maybe I shouldn't be 85%. Maybe I should be 60, 70% real estate. I don't know. Those are things that I have to think about. The other thing is to think about what other assets you want to be involved with. I'm a big advocate for alternatives in general. When I talk about alts, I'm not really talking about gold, but whether it's we're doing some stuff in the aviation industry with American Airlines, British Airways, things like that, that are somewhat similar but different in the sense that they may not be as influenced by the markets, right? So,
Yeah, more
private
direct to operator that along that line too, right? You're cutting out the middleman.
in this situation, just to give you an example, like we're buying like 747s and that sort of thing, and we are leasing them out to major airlines. So, say American Airlines is, for example, just leased one of our planes, and that's effectively a triple net lease, right? It's not any different, but here instead of having a bunch of individual tenants, you've got American Airlines as your tenant, and their balance sheet as collateral or whatever you want to call it. And then there's all sorts of in aviation, but they're different from real estate. We're also looking at doing some M&A, things like that. So I think it is important to diversify a little bit. At the end, I know my own limitations. I'm an entrepreneur, right? Like a bootstrap entrepreneur, and I'm a real estate guy, but I'm not usually going to be the guy who makes a deal with American Airlines, right? That's just really not what I do and who I am. So I know my own limitations. So part of what I have to do if I want to be involved with some of these things is to leverage other people's expertise. And in this case, like with my brother and stuff like that. So that's what we're trying to do, is we're just trying to create more of a platform for alternatives, high level alternative, not the podcast ecosystem, carbon capture, what all that kind of
Car
stuff.
wash. If I hear another car wash, I'm gonna go
I know
crazy.
Ponzi schemes and things like that. It's just trying to do some things that I think have some real gravitas behind them, institutional level quality stuff that you can bring to retail investors.
And I think maybe it goes without saying, but like, you got any like stocks, bond, mutual fund, like the normal sad American investment diet?
The only stuff that I have on that is related to the life insurance retirement plans, right? They are the leveraged, the premium finance, leverage finance stuff. And so I think I should have more. I just don't right now. I do think I should have more exposure to publicly traded equities. I do have exposure to the extent that these premium finance policies, they typically use the S&P 500, but they go up and they leverage the gains on the S&P 500, and then if there's no gains on the S&P 500, there's usually a floor as well. So I do have exposure to that, but I think I need more. And me 10 years ago would have been like scoffing at that notion of needing more. But I think as you get older, you realize there is a lot of value in having some diversity to your portfolio.
And in the new book, when your net worth goes over 8 figures, one of the big reasons is you and I are getting older and we're more likely to die, right? So our kids are going to be like, what the heck were these guys doing? And it'd be good if they had standard American investment stuff.
Yeah, that's why I'm such a big believer in life insurance too. Like my feeling on that is I could, especially some of these set it and forget it things, like you pay once and it's in place and you're done. Those are things that are hard to screw up a little bit. That's one of the reasons that I hit the insurance stuff pretty hard. So
Yeah. And that's why it makes sense. These alternative investment syndications, there's an ending point. So if you were to pass away tomorrow and that stuff keeps going for 5 years and have it directed into the life insurance is a good in case I die plan for sure.
yeah, and listen, in some ways that I think of alternatives because of the high rate of return on average, right? Obviously, we know that there's some risk. Listen, people have lost
Yeah,
money,
you
right?
mean it's not guaranteed, Buck?
It's not guaranteed.
I
Right.
want a
That's right.
guaranteed thing,
But it's the alpha, right? When people talk about the alpha,
So yeah, searching for A.
and it's the alpha. Yeah. And then as you accumulate money, then you got to start looking at shit. You might be buying some bonds and stuff, right? So I think it's an ongoing thing. It's fluid. If I'm 15 years younger, I don't think I'd still be thinking about this at all. I think I'd still be thinking about how to kill more buffaloes.
Yeah. And a part of that, Buck and I don't have any of these qualified retirement plans, solo 401ks, Roth IRAs. We didn't use that stuff to get here. But
No.
that's what the vehicle that you would hold, the standard American investment stuff. That's something to think about. But
Well,
or
for
maybe
me,
it traps people in that stuff.
maybe it does. I don't know. I guess for me, again, it's that cash value life insurance is the equivalent of that. It's like a big Roth IRA, but a lot less restrictions.
Yeah, exactly. Exactly. Any other parting thoughts here? I got a
Yeah.
kid now. Yeah, she's yelling in the background, but
Oh, yeah. I'll give you my thoughts on what's going to happen here because we've been in this inflation period for the last couple years, and people got freaked out by the CPI that came out like a week or two ago, and I think it was 3.2, showing that inflation actually had bumped a little bit. One of the things I would like to point out is that, and the Fed knows this too, is that if you break down that number, that 3.2 number, 70% of that was attributed to rental growth and increases. And I mean, obviously, you are in the real estate space. You know that rent increases are not significant right now, but they use the number 6.2% for that. And the reason they did is it's a lagging indicator. They use lagging indicators for the rent increases. Now, in reality, if you go to all of the data across the macro data, which I'm sure you look at, that is probably generously rent is probably increasing at 3% at best. In reality, it's less than that. If you
because
look at the
I signed my
macro,
guys up on 12-month leases, right? So
yeah,
if you're
right.
telling me it's 6%, dude, that was 18 months ago.
Exactly. And just for reference, the Fed, when they called inflation transitory, at that time, the real-time rent increases were actually 11%. So to give you perspective, that 11% didn't hit their CPI till 6 months later, right? Boom. All of a sudden, CPI is super high, right? So now they're using rent increases of 6.2% in the CPI, when in fact we know it's pretty much flat. And if that accounts for 70% of the CPI, imagine what that does to CPI 6 months from now.
We're already where we want to be.
We're where we want to be. And if you actually put that number in, that real time number, and say it's actually 1%, because that's what the macro data is showing, it's maybe like 1%, you're actually below target. You're actually below target CPI. So inflation right now is decelerating significantly. And then you put on top of that the whole quantitative tightening that's going on. It is really hard to imagine that 6 months from now, that CPI is not going to be at target at most, and more likely it's going to actually show that it's under 2, and that's going to, all of a sudden you're going to see some significant rate cuts, because as you and I both know, there's nothing that the Fed fears more than deflation. And if they push too hard, that's where they're going to get. And I just want to bring that up because I think in many ways, I look at this and I'm like, the writing's on the wall. 6 months from now, CPI is going to be target or below, because it is in real time. It already is, right? It's not like a fluid thing. It's written, it's already written down, right? When that happens, rates have to get cut. And I bring that up because a lot of people are in this decision-making mode right now because they're really worried about what are going to happen with rates. And if they're going to go higher, should I hold? Should I sell? Should I what? My suggestion to you based on this, the guy I got this information from, Campbell Harvey, and he was the guy who first described the inverted yield curve. That was at Duke for his PhD thesis. Smart guy. And he just blew me away with this. But look it up. And if you believe that, then you got to do everything you can right now not to sell, because if the rate cuts happen, the value in your properties, the value in your assets is going to go way up. And it may not be more than 6 months down the line. So that's what I would say is my parting words of wisdom.
But makes sense if the Fed's doing what they're doing, right? Because they want a surety that what they're doing is going to work, and they know what's going to happen 6 months from now, and that they're going to hit their target for their boss, which is the general public, and
Right.
they're going to look good. But they've damaged the economy more than they needed. But right, but I would say I look at it as the inflation is going to come back like a mother in a year or two from now, and that's why it's important to buy up assets that rises with inflation when it does.
Oh, for sure. For
It's
sure.
too
But I
late
think
in 6 months from now.
what you're going to see is cap rate stabilization, though, big time. And cap rates are going to come down when those rate cuts happen, right? So I think that's what I'm just worried people are panicking now and selling when they should,
Yeah.
or giving up when they shouldn't.
Yeah. Buck Joffrey, thanks for jumping on.
Yeah.
Appreciate. I'm sure we'll chat in the future. You guys want to check out his stuff, Wealth Formula. Buck doesn't sell you gold, so you don't got to
We're
worry
no
about
selling
that.
you gold. I don't sell you much.
But yeah, thanks everybody for joining. We'll see you guys on next time. Bye.
All right, man.
All right.